I mean, I guess I would clarify what the 2 years is a reference to. Is what we know is that it can take up to 2 years for the full effect of monetary policy to occur in the economy. It has to work its way through. It's that chain reaction or sequence of events that I described in the speech. So I don't know that we have a 2-year plan. We do have. We are aware that the decisions we're making now won't have an immediate effect. They will take some time. So that's why we I laid out sort of the number of indicators that we look along the way to see whether things are evolving as we expect.
The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right.
All right, so welcome back. Obviously, yesterday, the Bank of Canada increased interest rates by 0.75% to a total of 3.25%. That's the overnight lending rate. And today, the Deputy Governor of the Bank of Canada, Carolyn gave a speech, as they typically do right after they make a policy decision that is a statement decision. So in other words, they don't release an economic report along with it. And the information that was shared in today's speech is quite interesting because the Bank of Canada is setting the expectation that's going to take up to 2 years for the interest rate increases to come into effect and fully have an impact on the Canadian economy. But before we get into all the details, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And by the way, if you're in the process of buying a home, whether it's right now, 3 months from now, 6 months from now, 12 months from now, or 2 or 3 years from now, we are launching our Homebuyer Masterclass on September 12th. The last day to register will be September 11th. So if you are getting into the market for a home, you want to be involved in that class, because the one thing that we've realized through all the uncertainty that happened in the last 2 years is that education around real estate is the thing that is going to protect you. And it is something that is your responsibility and your responsibility alone. So you can go to homebuyermasterclass.ca if you'd like to register for that course. Okay, so let's get into it. Let's start first and foremost by talking about the fact that the Canadian economy is running hot. There's no secret to that. Inflation dropped from 8.1 to 7.6% in July. However, most of that was due to lower gas prices, which, by the way, is a good thing because lower gas prices eventually will lead to lower prices in other goods and services. But the majority of that reduction was, again, that lower energy cost with respect to transportation. Most of the other goods in the economy were still up in price as global supply chain issues and the war in Ukraine continue to have an upward effect on price pressures. Now, here's the thing. There's two stories happening here with respect to inflation. The first is the amount of money that was injected into the economy. The second was the amount of supply chain issues that resulted from basically restarting the world economy all over again. Because obviously, if you shut down an economy and you try to restart it, it's going to be hard to get the supply of goods back online. And that's what's happened. So we have two effects here: increased money in the system and a lack of supply of goods. Now, obviously, in this 8% inflation that we're running, part of that is due to more money in the economy, and part of that is due to the supply chain issues. The question is how much? And I think the best guess we could have is it's probably 50-50. 50% of this is supply chain issues. And at some point, you have to expect that those are going to go away as central banks around the world increase interest rates and try to reduce the amount of demand for goods. And then the other half is that monetary policy piece. Now, the monetary policy piece, a lot of that injected cash into the economy got eaten up when everybody was sitting home doing nothing. Now, there's still some of it that's still there. Obviously, there's excess demand because of excess cash that's available. And we've got this really tight labor supply, which is again leading to higher inflation, wage inflation, and everything else. But the question is, how much of this is temporary and how much of this is permanent? Well, as of right now, there should be a significant amount that's still temporary. I know we talked about transitory in the past, so on and so forth, but there should be some that's still temporary in the supply chain side of things. Now, the problem is if it becomes embedded. So in other words, if people start to expect inflation, then it happens as a result of people's expectations. So that's why the Bank of Canada has increased interest rates by 3% in basically the last, how long has it been? Let's call it 6 months. So 3% in the last 6 months. And the reason why they're doing that is they're trying to front load the reduction of demand. So in other words, they're trying to take the extra cash out of the economy, the extra demand out of the economy. So people stop buying things. And as a result, we end up in a scenario where prices don't go up as fast and inflation starts to reduce. Now, what's really interesting is that they're calling this a 2-year process. And that's where in the past, we've talked about the fact that when interest rates get really low, they tend to stay low for a long time. Obviously, this is the exception to that rule. And the thing is, central banks have a tendency to overshoot, especially when they're increasing interest rates. And that's because they don't know for sure when in that 2-year time period, the biggest effects will apply.
Monetary policy works a bit like a chain reaction or a sequence of events, and that sequence takes time. Both history and research tell us that changes to the bank's policy rate affect different households and different sectors of the economy differently and at different speeds. If you're making a big purchase or an investment, one that requires a loan, you'll feel the impact of higher rates almost immediately. And the sectors that are most sensitive to changes in interest rates are the ones that cool first. The housing sector here in Canada is a clear example of that.
So as a result, they're going to increase interest rates. They're trying to front load this, put a significant dent in demand right out of the gates. And as a result, they hope that inflation will go down. Now, this seems to be a concerted effort around the world as we're seeing other central banks increase interest rates, because what we have right now is not a Canadian inflation problem. We have a national inflation problem. And the Bank of Canada has acknowledged that the increases to interest rates are going to hit different households at different times, different businesses at different times. Yes, if you have a 5-year fixed mortgage, this is going to affect you at some point in time, 2 to 3 years down the road. You're not out of the woods. And if you have a variable rate mortgage with adjustable payments, obviously you're feeling this gradually as it is happening. Now, hopefully there will be some relief in sight at some point in the future. Those people who have variable rate mortgages with fixed payments, well, they aren't feeling it yet, but they're probably going to in the next 30 days as banks start to reach out and have discussions around the fact that people have hit trigger rates, which means everybody in Canada is going to feel, at least to some extent right now, a change in payments, whether it is immediately today, whether it's been gradually as interest rates have increased, or whether you have that 5-year fixed mortgage that you think you're safe in, but need to be planning for right now, because if you've got that ultra low rate, you need to be setting money aside so that when your payment does adjust at renewal, you're ready for it. Don't take this lightly. You absolutely need to be ready for interest rate increases because they are coming to you, even if you think you're safe with a 5-year fixed mortgage. The only people that are really safe from this whole thing in the next little while are people who took 10-year mortgages, and there wasn't a lot of them because obviously they weren't the most attractive options at the time, even though they were at historic lows. Now, as Carolyn Rogers said in her speech today, there's 3 things that the Bank of Canada is going to be looking at going forward. First is higher interest rates slowing demand and having the intended effect. Second, what's happening with global supply disruptions. And last, and certainly not least, is inflation and inflation expectations coming down. And by the way, the most important thing in the economy right now is inflation expectations. Not even so much inflation, but where people think inflation is going to go. So if we start sitting here thinking, well, inflation's embedded, it's going to be here forever, and we're making decisions based on that, well, it will become a self-fulfilling prophecy. So the Bank of Canada is doing everything they can right now, and this is probably why they're not following through on their promise to keep interest rates low until the end of 2023. It's they're trying to make sure that inflation expectations, so in other words, the thought that inflation might be here to stay, is something that is absolutely not going to embed itself in the minds of Canadians. And while it sucks right now, it certainly is the prudent thing for the Bank of Canada to be doing. A year, 2 years ago, when we were making mortgage decisions with the best information we had, which was the forecast from the Bank of Canada and the differences in the interest rates and so on and so forth, the inflation expectations were obviously significantly different than they are now. But given what's happened in the world economy and how the world economy has reacted as we've come out of this pandemic, well, unfortunately, even though it means higher interest rates for now and a little bit of pain for some households. However, keep in mind, you've still qualified at a rate that's still at least 1% higher than what your rate is today if you've got a variable or an adjustable rate mortgage. At some point, hopefully in the next 2 years, we're going to see interest rates start to level out, inflation start to level out, and things get back to normal. So that's the update from the Bank of Canada as of today. If you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so somebody like you can see this video, and we'll see you on the very next one. Cheers.